Hello, everybody. This is episode 8 of the Mechanics of Money. Dyron Bush. Let's go ahead and dismiss with the formalities and read our disclaimer, right? The first one is this podcast is for entertainment purposes only and does not constitute financial advice. Always consult a licensed financial professional before making investment decisions, and these are strictly my opinions, and please verify the validity of what I say. Now, I have a very interesting statement here, and I stand behind it. Again, these are exciting times. I'm taking my last graduate school course for my MBA at Grand Canyon University. Right now, again, I've been talking about major hurdles being placed in my way, and this time, this was a really major hurdle. I was hospitalized for 10 days. And that put a major problem with me graduating on time. Actually, I had to petition the hospital to allow me to take my final exam from the hospital. Right, that's how adamant I was about taking my final exam. Right, so I've watched other podcasters like myself run into trouble. Right, Donahue George, he had his car firebombed. He had his back fence firebombed as a result of some of the things that he's talking about on his podcast. But I will always, just like Donahue George and other podcasters before me, I'm always going to speak truth to power, right? I'm going to talk about the things that go on in the stock market, and right or wrong, but I'm going to talk about them. So again, we're going to talk about the three T's, right? We're going to talk about the taxes, the tools, and the truth. In this particular case, we're going to talk about all three T's this particular time. We're going to talk about the taxes, the tools, and the truth in its entirety with the three T's. Okay. We're going over the big beautiful bill in this particular section. We're going to talk about some of the changes that happened with the big beautiful bill. The first thing that changed is the car interest. Right, taxpayers can deduct up to $10,000 per year worth of interest paid on your new vehicle, whether it be an SUV, pickup, or a motorcycle, assembled. It has to be assembled in the USA. Okay. The next thing we have is tips. Workers in tip eligible occupations like servers, bartenders, rideshare drivers can deduct up to 25,000 of qualified tips and income per year. Um, then the next we have overtime, right? Which is the deduction is allowed the extra half time pay portion of overtime work. The premium above regular rate up to 12,000 for single filers and 25,000 for married filing jointly. And lastly, we have the TCJA, right, which is the pay rates, right, the pay rates, which was extended. The pay rates was extended. They were slated to expire, and they were actually extended by the Trump administration. Next, we're going to talk about the market indicators. Right, we have the fear and greed report, which is yellow. Okay, it's marked as greed and moderate. We have the 10-year Treasury yield, which is green. The yield is on decline. The yield curve is red. It's still inverted, which is an indicator that we are heading towards a market correction. The PMI is yellow. So it means that production is slowing down. Personal savings is red. Individuals are not saving as much money as they normally do. Consumer credit defaults, or people are defaulting on their credits at a higher rate. Commercial property defaults are yellow. We're starting to see an increase of defaults. Hedge fund performances are yellow. They're not doing as well. Credit default swaps are yellow as well as a moderate widening of the default swaps. CEO confidence is not very good in the economy right now. The PTFP usage, right, which is and also the RRP trend is declining as well. And we'll talk about this a little bit later. The RRP has actually reduced. Has been reduced down to $2 billion. Can you imagine it? At its height, it was $2 trillion, right? So now it's down to 2 billion, and that's a result of quantitative tightening. And of course, the BT the bank funding program has been canceled, right? We have the Nasdaq market breadth, where there is there's there is a more selling off of stock in the stock market as well. We also have uh, the Baltic Index, which is green right now, and the VIX, which is yellow. We're seeing a slight increase in volatility in the VIX. Okay, we have all auto default loan rates. You can see that the default rates have increased past 90 days. 90 days, past due 90 days has increased over the last 6 months substantially. Some of the information that we have is the Federal Reserve of New York delinquency rate on auto loans rose substantially above the pre-pandemic levels at by the end of 2023. Some subprime borrowers had a 60-day past due rate hitting 6.56% as of January 2025. And also, some major subprime loan um, companies, auto companies, have also went bankrupt as well, which is pretty substantial. With the home mortgage defaults, you're seeing a substantial increase over the last 6 months of the home mortgage default rate. Some of the problems is that people are upside down on their property taxes as well. So basically, when you initially evaluated on your house, the value of your house was higher, so you're paying property tax on a house that it currently is worth less than what it was initially assessed for previously, right? So you're upside down. So that's why the image of the house upside down, because that's what people are upside down on, and they're also upside down on the property tax and the mortgage. And what you see, if you do a lot of research, you'll hear people actually having showing buyer's remorse, right? They're actually saying, "Hey, look, I regret even owning a home at this point," right? They wish at some point that they maybe had an apartment opposed to owning a home. Now, what we have here is the reverse repo facility. It has dramatically declined over the last 6 months, and that's due to quantitative tightening, right? That was coming from the Fed, right? But the thing is that it's pretty substantial at its height. And I mentioned this earlier. At its height, the reverse repo was at $2 trillion a day. Okay, but it's now been reduced due to quantitative tightening to $2 billion. How about that? So, and then understanding that the bank loan funding program has been canceled. Um, the banks and hedge funds' ability to get credit has been hampered substantially. Of course, they can use treasury bonds now because they're using treasury bonds as collateral. The treasury issued more bonds and allowed they took off the limits that hedge funds and banks can have in terms of holding treasury bonds, so they can use that as collateral. But that's only temporary, right? And having collateral as treasury bonds is not necessarily a good thing. And there was a reason why they had limits on what hedge funds and banks could use as collateral regarding treasury bonds in the first place. So we'll see what happens, but definitely this is going to cause a credit problem within the market. Okay, now it's time for final thoughts. Um, I encourage you to visit my website, www.taxman.today, or you can send me email at dyronbush@taxman.today, or I encourage you to go to my blog at Ledger of Life. Let's go over today's quote. Today's quote is, "When the flow of cash slows and debt keeps rising, and the greater danger isn't the collapse, it's the illusion that everything is still fine." So what basically what that means is that if we look, a perfect example, if we look at the stock market right now, right? There's an illusion that the stock market is doing great, right? In essence, it is hitting record highs. But the thing is that, and I keep saying that, it doesn't mean that the two are mutually exclusive. When I say the market is not doing well, it doesn't mean that it's not doing good at the same time. And I know that doesn't make sense, but we're gonna delve into it and we're gonna explain it to those who are new to my podcast, right? The thing is yes, the S&P 500 is hitting record highs, but the problem is when you look at the market breadth report, it clearly shows that the majority of stocks in the stock market are selling off. So in layman terms, what that means is that the stock market is already crashing as we speak, and it has been crashing for a little while now, right? So in short, the only stocks that are holding up the stock market right now is the Magnificent Seven, right? Which are the major stocks, Amazon, uh, uh, stocks like that, right? Um, AI is kind of holding up the stock market as well. But the interesting thing about it is that how long can AI sustain itself? Is this just another bubble? And that's what they keep referring to, right? They keep referring to this being a bubble. How much progress are we making when Amazon is saying that they're going to lay off 600,000 jobs by 2033 because they're going to AI and robotics, right? So these are some of the things that happen in the aftermath of of the AI technology progress, right? So we have to look at that and say, is that really progress, right? Are we really doing better when 600,000 employees are unemployed, right? They're going to be dislocated workers. That's how they're going to be classified. Okay. So next up, we're going to look at the national debt. The national debt again is $38 trillion, right? How about that? $38 trillion. 20 years ago, the debt would probably go up. It would go up every 2 years, $1 trillion. But now, in recent times, the debt goes up $1 trillion every 5 months. So um, this is not sustainable. We've already had our credit worthiness downgraded, similar to China. We have the de-dollarization of the dollar. I mean, the dollar is no longer king, right? The brick is king now, right? Did we ever think we would actually say that? The dollar not being the prevailing currency in the world. You know, so we have to do something about this. We have to do something about our national debt. It's not sustainable. And matter of fact, last week I gave a quote from Warren Buffett about this, the way uh, our country treats debt, right? And how it will end up if we don't address the issue. So here we are. We're looking. If you look at the chart that I have above, um, in the upper left-hand corner, we have the Donahue George case, right? I keep mentioning this case because it's quite interesting, right? Why does it interest you? Because it should interest every stockholder in the stock market, right? Because it harkens to what is wrong with the stock market as it stands right now. Um, Michael Lewis talks about this all the time. In his book Liar's Pokers, right? He talks about how there is naked shorting in the stock market. Some people hear people talk about naked shorting and they gasp. They say, "Oh, he's talking about naked shorting." This stuff goes on. Michael Lewis has a best-selling book talking about these things. This is not new. This is not nouveau. There's no need to hush somebody over this because this goes on. And all Donahue George is doing, he's suing Ken Griffin, SEC and FINRA, and other hedge funds, and all Donnie George wants to know is, where are the blue sheets? Again, what is the big deal about the blue sheet? The blue sheet will specifically show the second to second transactions that go on with hedge funds, right? And the thing is, within those transactions, it will show whether there is naked shorting, right? So for those who are saying that, there's for those who are saying there's no naked shorting, then all you have to do is look at the float of any of these meme stocks, right? If you look at the float of any meme stock, and you see the float is 500,000, right? It's 500,000, and then all you have to do is look at the FTDs, right? So how the FTDs a billion, right? They add up to a billion, and the float is 500,000. That means that they issued more share. They issued more shares than what the float is, right? And that's impossible, right? Obviously, that means that there's synthetic shares out there. They're fake shares, right? That's just simple math. Uh, will tell you that, right? So that's all Donnie George is saying. He's saying he's a stockholder, and he wants um, to be able to see that there's no nefarious naked shorting going on or synthetic shares. And this has been taking 4 years, 71 days, 21 hours, and 4 seconds, right? Um, for them to actually produce just the blue sheets, something that they can produce very quickly. And again, this is not me just talking about this, right? This is something that Michael Lewis talked about in his book, Liar's Poker. This is something that Elon Musk talked about. Elon Musk specifically said in a quote, he was saying, hey, he was addressing the issues. He was saying, you can't sell a house that you don't own. You can't sell a car that you don't own, but how is it that you can sell stock that you don't own? I.e., naked stock, naked shorts, or naked or synthetic shares. So these are prevailing issues that people are inquiring about. Uh, Also, we have my graduate school, right? I'm graduating in 43 days, right? I've had some major hurdles. I had to spend 10 days in the hospital, where I actually had to kick, bite, and steal to actually take my exam at the hospital, right? I had to actually do that, right? So yeah, so it's crazy. It's crazy, you know, flashing back to the 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 former topic I was talking about, is that you don't see Elon Musk's car getting firebombed. That's what happened to Donahue George, right? And you don't Donahue George's fence was actually burnt down too. And you don't see Michael Lewis's car getting burnt down or firebombed for things that he was saying about naked shorting as well. So it's quite interesting how this is being treated for those who speak about these things in the stock market. So let's talk about some general things in the economy, and then we're going to wrap it up. Um, the private sector's declined. ADP reports that the private sector jobs have dropped by 32,000 in September. The leisure and hospitality is down 19,000. Construction is down by 5,000. Manufacturing is down by 2,000. This is the third month out of the fourth where private payroll decreased. And this is this is a very important statement. Fortune magazine states that the third of the U.S. is already in recession. Now, again, remember I made this statement several years ago. I was saying, hey, we were in recession, right? And a lot of people scoffed at me and said, I don't know what I'm talking about. But the thing is I was proving that we were in a recession, because what they did was they changed the calculation of what a recession is. So I mean, you can't cover up a recession by changing the calculation of what a recession is. We were already in a recession, and just the new job numbers alone that came out by the BLS that proved that we had that made the correction. Well, hundreds of thousands of jobs are actually lost, not gained. Proved that we were in a recession during this period of time. Um, this is the weakest job report um, in 2 decades, right? Trump's ordered the BLS not to report the September job report, uh, and we know why, right? The job report is not it's not looking good. this and Mark Spingle, a hedge fund wizard uh, that bets on the stock market mayhem. He's always on the opposite side, right? The downside of the stock market trade. This guy predicts the crashes of the economy. He made a specific statement. He said the U.S. economy under Donald Trump is barreling towards a catastrophe that could rival the Great Depression. The administration recently meddling with the stock market has created dry kindling for the stock market blaze that could torch everything. Spingle is known as a Wall Street crash guy. He stands by his track record. We also see that silver has squeezed, which put hedge funds in a very precarious situation. Keep in mind, this is what toppled Bear Stearns when silver squeezed. Um, Gita Gottlieb is a former IMF chief economist, and she says the stock market. One second. She says the stock market crash could wipe out $30 trillion worth of wealth. The Bank of America states that the credit problems could trigger a dot-com like crash that could wipe out 20 trillion. And again, Amazon saying that they hope to replace humans with robots, 6,000 workers by 2033. And gold has dropped the lowest in 12 years. France's largest bank just plunged 19%. And this is very interesting too. Jefferies is the 10th largest financial institution in the world, and it's facing very large redemptions from its clients. And again, redemptions mean that the clients are basically asking for their money back, right? Because they lost the vote of confidence in the financial in Jefferies. And to understand, the number 9 financial institution is Deutsche Bank, which has shown signs of weakness as well, right? So the contagion is spreading. The Federal Reserve just determined that hedge funds have $1.885 trillion worth of short positions overseas in the Cayman Islands, which is 4 times higher than what was originally thought, right? So, so all these things are information that could be margin call type issues, where on the financials, the hedge funds are showing one thing, where their short positions are 4 times less than what they really are. They're actually $1.8 trillion worth of short positions. That's my 2 cents. Make sure you like and subscribe to my podcast, and I enjoyed talking to you. And hopefully, I'll see you next episode. And thanks for everybody that subscribed. Enjoy.